Yes, investing in multifamily apartments, it's amazing. But of course, every investment comes with risk. Anyone who tells you otherwise is lying. So, here are some of the top risk factors of any multifamily investment and how you can mitigate against them. Number one is illiquidity. Multifamily investing takes a lot of money and it takes it and it sets it aside for a long period of time, years. So it makes it difficult to get your capital back quickly if you have an emergency. So I always do my best to tell investors, look at your timeline for the next 3, 5, 10 years. And if there's any big event you see coming that you're going to need money for, make sure that's not the money you're investing into a multifamily deal. Number two is the possibility of a recession. Look, a downturn in the economy can hit every asset class, not just multifamily apartments. If there's a recession, it can impact the rents as well as the collections, as in, are you even collecting the rents that your tenants are signed up for on their leases? It can also impact your occupancy, as tenants who get strapped for cash might double up and move into the same unit together, leaving one of your units empty. Number three is choosing a poor operator or bad property management. An inexperienced operator who doesn't know how to handle challenges can really impact your investment returns and even put your money at jeopardy. Number four is overbuilding or oversupply in the area. As markets get really popular, builders go out and build a ton of apartments. Well, simple supply and demand. If there's too much supply, then your rents might drop, your occupancy might drop as well. Fortunately, in Class B and C apartments, there's not as much building going on, so that class of apartments tend to stay pretty resilient. And number five is legislative changes. This can have a significant impact on multifamily investments as things change, like renter and landlord laws, eviction laws, rental moratoriums. All of these things can be out of your control and can come down from on high as the laws change. Now, to mitigate these risks, make sure you're using conservative underwriting. Be sure to evaluate the debt that you're taking on, as well as how that debt's going to change over the years, if it's going to at all. Use conservative cash flow projections. Don't always assume that everything is going to be amazing. And look at the worst case scenarios and have an action plan. Look at, if the worst things happen, how does that impact returns? And if you can live with returns when the worst case scenario happens, then you might have a winning deal. Number two, diversification. So if you're going to invest in multifamily apartments, choose different markets, choose different operators, and spread your money around to spread out your risk. Maybe even diversify within multifamily. Do some ground up development, do some Class B, some Class C, some Class A, some office to apartment conversion. And finally, perform thorough due diligence. This can help you to avoid bad circumstances that might come down the way. You want to look into the operator, the property manager, and the market itself. Ask as many questions as you can possibly think of. I always tell investors, no question is off limits. After all, this is your hard-earned money, so I want you to put a lot of time and a lot of thought into what you're going to do with it when you invest it. My name's Chris Collins. At Amity Cash Flow, we partner up with passive investors who want to invest in deals where we've done a lot of this due diligence and a lot of this research to put your money into as risk-averse properties as we can find. But like I said, every property comes with risk, and if you're not ready for that, then please don't invest in multifamily apartments. My name's Chris Collins. We'll talk to you more tomorrow.